welcome to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. Before we get started, I'd like to send a huge thank you to Alexa Cook for hosting these sessions for the past 3 years. Thank you so much for providing such pivotal information to the world of Treasury, and we wish you the best of luck in your future endeavors. So starting on kicking off in this coffee break sessions, I really want to kind of bring in a little bit of a series of investment topics. Chatting with me today is Paul Galloway, Senior Advisor at Strategic Treasurer. Paul, how are you doing today?
Doing great, Jason.
Fantastic. So getting things prepared for the session today is really kind of looking at these investing topics. And one of the things that kept popping up was efficient frontier. Kind of walk us through what exactly is the efficient frontier.
This is an investment concept that's been around for quite some time and has been a foundational basis for portfolio management for decades. So I'm going to try to keep it simple and think about the efficient frontier in terms of a graph. So on the horizontal axis, you have standard deviation of potential returns, which is risk. And then on the vertical axis, you have expected return, what you think you're going to get for a return on a particular asset or security. And what the efficient frontier does is it says, okay, let's take a stock and bond portfolio, two different security classes, and make up a bunch of different portfolios based on expected return and risk, which is standard deviation. And when you do that, you can make up a curve that starts in the lower left corner of this graph. It builds up and then it starts curving when it gets up so far out and off to the right. Any point along that curve, there is a portfolio that has maximum expected return given a certain level of risk.
Why is this theory important to making an investment decision for anyone?
Yeah, it's a great question. Not every investor is the same, meaning that certain investors have a willingness to take on more risk than others. They also may have the ability to take on the risk. And some folks may not be willing to or have the ability to take on additional risk. So it comes down to a person's risk appetite. And so if you were to go and sit down with your personal advisor for your IRA, for instance, they're going to go through and ask you a bunch of questions about risk tolerance. If you are a less risky person, you would pick out a portfolio at the point where you get the maximum expected return for the most risk that you're willing to take. Somebody else could be more risky or willing to take on more risk, and you will go up the curve further to the point where you hit their expected return given their level of risk. And if you were to look at the expected returns of those two, the less risky person is going to have a lower expected return, and the more risky person is going to have a higher expected return. Now, of course, history or past returns are not a direct reflection on the return you actually get. There's a lot of factors that go into that. But if you're able to build a portfolio that maximizes your potential expected return given risk, that's what you're going to do. And the efficient frontier maps out what that looks like.
So really what we're talking about is more like it's that gamble, right? It's that either the thrill of the hunt or the thrill of just being more conservative.
Exactly.
So what makes it so efficient?
The efficiency of this particular approach is that when you map out all the potential expected returns given level of risk, you're able to maximize your expected return. You can have a particular level of expected return, and you could have all kinds of different portfolios that might fall in the same risk category, but would offer less expected return. And so as an investor, I'm going to pick whatever's going to give me the maximum. So if The lowest portfolio is, let's say, my expected return that's maximized for the given level of risk is 5%. But I go down for the same level of risk, I could pick a portfolio that offers 3% return. I would never pick the 3% portfolio. I would always pick the 5% portfolio. Why? Because I have the exact same level of risk. Investors, they're always going to pick the higher return. At least they should pick the higher return.
So are there any inefficiencies in this theory?
The inefficiencies in the theory are that expected return turns out to be something different than what actually, what you expected to have. The risk associated with a particular investment may end up being more risky because of things that you didn't know or you weren't able to find out through your fundamental analysis that you did on the particular investment. So sometimes there's hidden risks associated with investments. And we've seen that happen in markets from time to time where companies have falsified information or held back information that was relevant to investors, or things were happening on the inside that influenced the price of a stock. Yes, it's efficient in terms of getting you to the maximum return given level of risk, but it doesn't capture everything in the market.
So with all that being said now, is it possible for the frontier to become even more efficient?
Absolutely. So we talked about a portfolio of stocks and bonds earlier. And if you think about that curve that we created, if you add another asset class, let's say real estate, to that mix. So you got stocks, bonds, and real estate now. Real estate has a different expected return and risk profile than stocks and bonds. The addition of real estate, you can actually push the efficient frontier out, meaning that you can get an even better expected return for a given level of risk.
Thank you so much for all that information around the efficient frontier. Thank you for joining me today, Paul. And for our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or any suggested topics you would like to hear, please send us a note at podcast@strategictreasure.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.